Well, Jerome Powell came out today and we saw some big time volatility. In today's episode, we're going to focus in on making sure that we don't get our faces ripped off if we get a squeeze back to the upside. There are some interesting correlations going on in the market, so we're going to cover that on today's Stock Market Brief episode, where we navigate the financial markets through the lens of technical and intermarket analysis. Before we get into today's show, I want to remind everyone, thank you for joining the swing trading community, which is only $9 a month. All my patrons that support this channel, you can save money by signing up annually. It's only $7, and we have all kinds of benefits that I'm not going to read off here. And many thanks to my partners, Interactive Brokers. If you actually click the link in the description below, make sure you take a look at their Interactive Broker campus. They have tools, resources. They're working on a new platform that kind of looks like Webull, but then they also have webinars and courses too, all provided for free. It's very cool stuff there from Interactive Brokers. Let's go ahead and get into today's episode. All right, people, welcome back. Jerome Powell was out today in the press conference letting us know that he sees no stag and no inflation. Now, there was a couple of notes here. We did see massive volatility, a big old roundabout right over here. We had some lack of progress to 2% inflation. That was noted by him, but we did have dovish comments to cut the cap on the balance sheet runoff slightly more than the previously communicated. We did see a rally coming in and around after that point that he had mentioned that, and he stated that the next policy move is unlikely to be a rate hike. If we take a look at the Fed watch tool, or the median probabilities of a rate cut, rate hike, where are we? Well, we don't see a rate cut up until November now. It's being priced in around there and into December, so a 25 basis point rate cut still is what the probabilities are saying. But as far as Jerome Powell said today, it's really up to the data that comes out. So what happened on this news with Jerome Powell and the Fed press conference, among all the other macro reports that came out today, the yield curve actually went down. And I wanted to call this out because as the yield curve goes down, what we've seen in the past, when we're actually in an inverted state, we've been in an inverted state for quite some time. When it goes deeper into inversion, what do you see the S&P 500 do? Well, the inverted yield curve goes deeper into inversion, and you actually see the S&P 500 rally. These red squares are highlighting the times where it starts to uninvert, and you get some turbulence there in the S&P 500. So I wanted to call that out because right here we saw the yield curve go deeper into inversion today, and the S&P 500 responded in a positive correlation there. Wondering here if we just got to see some digestion, and if the yield curve is going to come off a little bit or go sideways, if the S&P 500 is going to catch some relief. Another big mover today that we got to pay attention to is the dollar. The dollar really came off hard and fast. A lot of volatility there. You can see here the dollar came off during the cash market session after we saw a big drop again. So what was that? Well, this could be intervention taking place with the Japanese yen. You see the pair right here, US dollar, Japanese yen, seeing a big sell-off here. So there was comments saying that there was no comments saying that it was confirmed, right? As far as an intervention goes. But, moves like this typically leads us to believe that it is an intervention. And then also, if you look at the Jap, go back to, a couple of trading days ago too, the USD JPY also saw the turbulence over here leading into Monday's cash market session. You can see Bank of Japan accounts suggest Japan intervened Monday to support the yen, but they have not, said if they stepped in to buy the yen as it states right now, okay? So they're not saying that they did, but yeah, they probably did. And what I find interesting here is the 10-year yield. So the 10-year yield backed off today, and you can see the price momentum oscillator starting to curl around. And as we priced in a little bit higher, we had a little bit of a negative divergence, similar to here, and we started sinking off prior. It doesn't necessarily mean that we're gonna come off, whoa, like crazy. But I do want to call out this specific chart because if you look at the pair, right, this is nothing new here. If you look at the US dollar versus the JPY, so the yen, and then you have the 10-year yield in the background, they do move in lockstep with one another. And I mean, they've been highly correlated. It's nothing crazy. But as the US Treasury yields, they rise, it helps strengthen the dollar. So as the dollar strengthened, obviously JPY weakens against that. So the yields are really tracking a lot here. And the reason why I'm calling this out is because if we start to see, this come off, the pair come off more, is it giving us insight that, the 10-year yield may come off? And then also to note, if this line goes down, that means that the dollar is weakening against the strengthening yen. And that we've seen some very interesting correlations with a falling dollar. And that's why I want to bring up dollar correlated charts to see where we kind of stand if the dollar were to come off further. So looking at the S&P 500, we'll look at different time frames as far as correlation goes. We have a 15-day, right? We have a 15-day here. We have a 30-day. We have a 90-day. We have a 120, and we have a 180 even beneath us. And when you're below the zero line, which is this dash line, when you're below that, it means you're in negative correlated state. So while I'm saying, be careful until we don't get our faces ripped off, the US dollar compared to the S&P 500 is at a negative correlated state as it stands right now, meaning if the dollar drops, the S&P 500 could go up on a 15-day basis, right? And then you have a 30-day correlation. It's even deeper negative correlated state here. So if the dollar comes off, for multiple days or whatever, it could lead the S&P 500 higher. Now, on the longer time frames, we started to see a positive correlation start to step up, and that's because it was in a positively correlated state. But the longer these closer time frames obviously stay negative, these will start to drive down there too as well. So the negative correlation in the near term, if the dollar does decide to come off, this could be something to watch here, and why we say that the S&P 500, where it currently stands, we may get a face ripper or a squeeze, but there's a very, very key level that I want to touch in on here in a moment. Another thing to pay attention to is gold. Gold is actually in a positively correlated state with the dollar, which is that's a little bit of a red flag in and of itself right there, because typically you have the dollar go down, gold goes up. That's what it typically is. And you can look back through history, 180-day correlation. It remains negative for the majority of the times, 120 and 90-day. But you can see they've been turning up because in times of, these geopolitical tensions, the dollar has been rising and gold has been rising too, driving these correlations. So there will come a time where they go back to negative, right? But as it stands right now, if gold comes off, it's still saying if the dollar comes off, it says here in the near term, potentially gold can still follow and track that as well. And then we have oil, which is another big time, geopolitical or economic, commodity. And right now it's actually really not showing a correlated state in the 15-day and 30-day. Now, if I were to show you the correlation, I don't have that chart with me right now, correlated to the 10-year yield, as the 10-year yield backs off, it is highly correlated to oil here. So if the 10-year yield decides to come down, right, oil's got hit today, got follow through today with the 10-year yield. Now, it's pretty extended to the downside, so we could very well see a snapback or consolidation, but just note that this is tracking the 10-year yield pretty well. So like I said, if this comes off, this pair comes off, the 10-year yield comes off, it could still put us in a period of digestion and pause for oil or various energy names, which have been getting hit here, which I still think that there's an opportunity there, but you may just need to be a little bit more patient for price action to kind of tighten up. If you look at gold on the absolute term right now, gold is just consolidating. I was looking at potentially that this is just flagging or wedging. So if gold wants to find some more strength and break out for another move, that could be something very well to watch. Another thing that happened today that I found interesting that leads me to believe that we could potentially, if the market's not going to sell off further, which I'll go over those key levels to watch, could get a face ripper. And that's high yield was actually up on the day. S&P 500 finished down on the day, which is one of those, you can see here on the very short term, positive divergences, which we called out this one over here, right, where the HYG, smart money, right, closed higher low, and the S&P 500 had a lower low. Okay, and what did that lead to? It led to the S&P 500 rallying a bit here, and now it's kind of just choppy with a lot of volatility. Overall, the markets today were rather flat to unchanged. So if you just tune it in now, you're like, today was a nothing burger. Well, you'd be gravely mistaken because the amount of volatility we had intraday. Now, let's zoom out a little bit and look at the monthly time frame. We'll go over the monthly expected move. This was last month, right? That was the monthly close of the candle. We came down to the quarterly expected move in the monthly 5 EMA. We're above the monthly 5 EMA right now. So on a monthly term basis, that's a positive sign. Now, if we start to sell off further, which we'll go over the key levels, the lower expected move for the month is 48.50. We're going to round it 48.50. That's the lower, and that lines up fairly good to this prior all-time high over here, and that would be outside of the quarterly expected move. And if we get outside of the quarterly, there's always a possibility, right? A higher probability is that we close back above it by quarter end. So nothing's a guarantee, but we're talking in terms of probabilities. From a weekly perspective, we're still trading within a couple of weeks ago. As you can see right here, we had an inside trading week the last week, and this new week we're trading inside of that candle still. So as we're getting a lot of volatility, understand that it is actually still contracting from this very volatile week here, and we're below that declining 5-week moving average. And when we get very extended from it, it's likely to see snapbacks. We talked about that when we got extended here. We saw a snapback. We got extended here. We saw a snapback. We got extended here. We saw a snapback. It's frequently tagged. So to see a snapback up to 50-50, 50-75, or even 5100, which we saw basically today to the screw, that's, very, very possible, and we got to be at least aware that that's something could happen. Now, if I look at the S&P 500 on a daily time frame, right now we are at a critical level. That critical level is the lower weekly expected move. We actually, if I zoom into it, you can see that we came down there today and we just tagged around it. Now, this is very commonplace. When you get down to the lower weekly expected move, you just doodle around it for a few days. But if it starts breaking further to the downside, that's where problems can occur. And you could see today, obviously, we came almost back to unchanged for the week, and then we closed right back down at it again. If I look at the 15-minute time frame, you could see it right here, the weekly expected move. That's for the SPY. Okay, and then we're below the 5-day moving average. It's rather flat to neutral as it stands currently right now in this instance. Now, I want to go over some gamma levels. These gamma levels are incredibly important. Earlier in the trading session today, we called out some of the key levels up in this range over here as a potential target. And then as the day progressed, 5100 really started to stand out. And when that got tagged, sure enough, we started to sell off from that point. So we're still in negative gamma territory. And if this doesn't make sense to you right now, what I've been talking about gamma, right, negative gamma territory, right, the last day, today and the prior trading day, those closes should give you enough information as to why it's so important to understand what it's like to be in negative gamma. That's where you get selling into selling, buying into buying. You get very volatile price swings. It's when we get back into positive gamma territory, you start to see dealers buy the dip, sell the rip, and then volatility suppresses. There are contracts. Now, let's continue on, because if I look at ES, there is a key level, and the level that I want to really pay attention to here is going to be the I'll show you on the gamma perspective. It's going to be 5,000. This right here is the put wall. Okay, the 5,000 is the largest put wall, which can act as the level of support. Now, if this level is broken, we can see, significant moves to the downside. And as I've already stated, we're right there at the weekly expected move. And if we start breaking down through that 5,000 level, I'm showing ES right now, so it's a little bit different. If we start breaking through that, which is about, right around this area on ES, this can be a potential target. And that target, if you look at Bookmap, we've had now 2,500 contracts sitting in around that area. So I'm highlighting this area, which would be a retest of the swing low. And I wouldn't rule it out that if we get some more volatile price action, we can swing in, fill that, and undercut it, and then really kind of determine where price can go from that point. On this sell-off here, there were so many indicators flaring up red, telling us that things were oversold and we can get a bounce. And then as we bounce, we said, where can we potentially go to? Well, we can go to, right, up to and around the 50-day moving average or this downsloping trend. And it pretty much to a T played out to be that way, okay? So now we're kind of in this rough spot, getting much more larger daily swings, and we're coming into a period of more data drops, like Apple reporting after the bell. We have non-farm unemployment. We have ISM services on Friday, and we have a whole host of data tomorrow too as well. So be careful out there. We're right there at the lower weekly expected move, but there are signs showing that, hey, if the dollar comes off further and HYG, right, continues to catch a bid here, this could tell us that we're due for somewhat of a bounce in the near term in the S&P 500. But just be aware, if we start cracking down that put wall, that's where things can really, really get crazy. Hope that helps out on today's episode. See you guys later.